Hello, and
Hello, Professor Ehud.
Greetings.
good
to see you guys.
Greetings. Good to see you too.
Thank you. Good to be here.
Well, great, and a wonderful good evening from the VU Executive Academy to all our listeners who have tuned in today to the MBA teaser class with Professor Ehud I. Ronn, who's joining us from the University of Texas at Austin today. So, how is the weather today in Austin?
It's gloriously warm, Anna. It's in the high 30s. I think you would all love it.
Oh. That's great. Yeah, we just wrapped up our info session this afternoon now with with an alumna and a student, and we're really excited to hear now what you have to say on the developments in the commodity markets. For everyone who's new joining us today for this MBA class, my name is Anna, and at the end of this lecture, but also during the lecture, you're definitely invited to ask questions. We're going to invite you to actually use your microphones and ask questions if you have any. We would, however, appreciate it if you could use the hand signal to just give us a heads up that you'd like to ask a question, and then the transitions are a bit more smoother. Alternatively, feel free to post your questions in the chat, and I will take the role of asking that question today to Professor Ronn. And a little bit about his background. Actually, he's been working in quite a few different fields. Among them, he was the vice president of a research area from Merrill Lynch. He has a lot of insights on modeling practices for the commodity markets. And today, with the COVID-19 developments in the global global commodity markets, he's going to share with us his insights on what he thinks has been happening and what if we can make any future predictions on how things might go. And without further ado, before we get started, I'd like to introduce you as well to one more special guest here with us tonight, and that is my colleague, Mak Baraktarevich. Mak, would you like to say a few words?
Yeah, hello to everyone. Thank you for joining us today, Professor Ehud Ronn, and thank you, Anna, for again leading through this webinar. And thank you for everyone for tuning in. As many of you may know, I'm the program manager in charge for the energy management specialization at the VU Executive Academy, and Professor Ehud Ronn is one of our faculty members. He's teaching energy trading at the VU Executive Academy, and also during our specialization US field trip at Rice University. And we are very glad that he was today available also to give us the webinar and his insights on the message from the markets. And therefore, I'm gonna leave the stage for you and hope you enjoy it.
Well, thank you very much, colleague, for that gracious introduction. I'm going to see if I can make Lawrence proud by taking sharing the screen that I would like to do here. Yes. So before I begin, let me just thank a couple of people. First, my colleague Jonas Puck from the director of the MBA Energy Management Program. I'd like to thank my counterparts, Anna Patterson and Lawrence Ditterstoffer, for their collegial assistance in this, and especially my colleague Mak Bjajterovich, who has been working indefatigably to support this presentation here. So with that, ladies and gentlemen, let me turn to the presentation. And as Anna collegially said, you're welcome to address questions and comments throughout. I'll also stay at the end if you want. Be delighted to stand around and address your comments. As you can see, what I wanted to do here was really a couple of things. The first and foremost one is to give you my perspective on how I think of the message from markets. And that term, ladies and gentlemen, is designed to connote the fact that markets speak to us. And the challenge sometimes is to interpret what exactly they're saying. So what I'd like to do is I'd like to present to you my perspective on how I see what the markets are telling us in the different areas. I'll be focusing on oil, but I'll touch a little bit on equity and credit as a lead-in to what I'd like to talk about in terms of the oil markets by speaking first a little bit about the equity markets. So don't hesitate to speak up if this is not all coming through. But what I'd like to be able to do is present my presentation, of which you should have a copy. I also have the ability, as you may know, I don't know if this has been introduced to you, to bring you Bloomberg directly into our discussions here, and I'd like to be able to use that hopefully successfully. Anna was kind enough to introduce me. I won't take up more of our time on this. I hope to be able to do that at somewhat greater length when we have occasion to meet, hopefully in Houston, if not in Vienna in September. But the point is that I've been doing this for a good many years, and I've had the privilege of doing this both in academia and, as you can see here, in the real world as well. And so hopefully that will give some background perhaps to what it is that I'll be talking about. So it's not an entirely selfless exercise, as Anna and Mac may have told you. I would like to give you an update on what's been happening in the markets as I see them, and perhaps, as I said, and I'm repeating myself here, give you a specific perspective on the kinds of things I like to look at, but also, admittedly, to give you a little bit of an introduction / promotion to the energy trading class that I'm scheduled to deliver in September. So I'll take a couple of minutes of your time of that at the very end. But right now, let me begin by talking about those indicators in markets, ladies and gentlemen, that I like to look at. And one of the biggest ones is obviously what's happened to equity markets, but in particular, I'd like to show you how implied volatility on the different indices is an incredibly interesting perspective on the nervousness and uncertainty in markets. Okay, so this is my first indicator. It's one which I'll define to you very briefly, but I'd like you to think of that as two things. It's forward-looking, and it is an indicator of market nervousness and uncertainty. Many of you may have heard already of Vixx and some of these other indices, but I will briefly introduce them just to make sure that we're all on the same page. In terms of the indices that I'll formally talk about, I'll talk about two of them in particular, Vix and V1X. So Vix pertains to the equity markets here in the US, and V1X used to be called VDAX, pertains to the implied volatility on the Frankfurt Stock Exchange. Not quite sure why they changed the name from VDAX to V1X. I thought VDAX was incredibly explanatory and descriptive, but they decided to change it. So I'll talk about those two. Now, many of you, as I said, are likely to be familiar with Vix, but perhaps fewer have seen what I call the turn structure of Vix. And all I mean by that, ladies and gentlemen, all I mean by that is that you should look at Vix not just as the short-term measure, but also look at implied volatility further down the road. And by further down the road, I mean as long as 2 years. And again, remember what our objectives here are. Our objectives here are to discern, to be able to elicit from markets what it is that they're telling us about the world and how we might look towards the future and what it is that it's telling us. And perhaps this is as good a time as any to talk about my view of markets. So as you can probably already deduce from my presentation, I'm an adherent of efficient markets, but I want to make sure that I understand that we all understand what that means. It means that markets are hopefully efficiently processing information. It does not mean that they're omniscient, that they're prescient, that they can see the future. Obviously, no one can. They're trying to do the best they can at that, and that's what it is that we're going to be discussing. All right. I'll take one page on the U.S. corporate high yield just as a way of saying how it is that credit markets are looking at this. I know we don't have much time with that, so I won't take too much of that, but one page on that. And then the big picture is what we need to talk about in terms of the oil markets over the past 3 months. As I'm sure you know, and I'm not the first one to say this, obviously, it's been an incredibly telescoped 3 months in terms of that to which we have all gone through. So I'll talk about oil prices. I will talk about the slope of the curve. So what I'm going to do is depicting for you the futures curve all the way out 8-9 years into the future and seeing what it's telling us about the markets. I want to talk about the issue of OVX. I apologize for the phone. Sorry about that, colleague. I've tried to disable my phone, obviously with no success. Okay, OVX. OVX is comparable to VIX in giving you a 30-day forward-looking implied volatility on oil markets. So I'll talk about OVX as well. I will take a moment to talk about oil equities. So these are the large major oil companies whose stocks are trading on equity markets. I would like to take a little bit of time to compare and contrast the last 3 months with the Great Recession in terms of the oil markets. Here's one that will be, I hope, a little bit different from perhaps things that you've already seen, which is, can we come up with measures that allow us to distinguish empirically between supply and demand side aspects of the current crisis? And perhaps a moment or two what I mean by supply and demand side. So the demand side obviously is the collapse in the demand for oil products because of the current crisis. Supply side is the surge in production that happened, at least temporarily, perhaps no longer, from two sources of oil producers. One is the Kingdom of Saudi Arabia, and the other one is the Russian Federation. Can we look at how oil markets are attempting to distinguish between the supply and demand effects? I'd like to share with you what we learned from Professional's oil price forecast. So again, remember, we're all interested in what we can see about the future. And so I'd like to take a moment on that. Probably won't spend too much time, but you've heard that the WTI went negative for one trading day. And so we'll talk about that very briefly. And then with your permission, I'd like to talk just a little bit about what we'll be doing in September when we convene for the energy trading course. So that is what we have in line. And what I'd like to begin with is a comparison of the equity markets, both within the North American context, the S&P 500, and the rest of the world. So what I've done here is, you'll notice that what I've done is I've contrasted for you two indices. And the way to read this graph, ladies and gentlemen, is the following. What you have is, you have two price indices in the upper panel of the graph, the S&P 500 and the MXEU index, which I will define in just a moment. And then in the graph below, you have the difference between them. So the differential rate of return over this period. I've normalized both of them to a factor of 100 on February 18th, 2020, so sort of the beginning of this situation, to see how they've both developed over this time period. So this is a Bloomberg screen of the kind that I am very fond of presenting. And as I said, hope to have the opportunity to present this to you in the fall. Let me tell you what MXEU index is. MXEU index is the index in Europe of equity prices over there. So essentially what I'm doing is I'm comparing and contrasting basically the stock markets in Europe with the US market, as you see over here. Okay, so basically I'm not going to surprise anybody here by telling you that we had a precipitous decline of 35% in both the equity markets here and the equity markets in Europe. And so you see this precipitous decline over here. This is the European index, and this is the US index over here. And then we've had somewhat of a recovery since then, with some differential behavior that remains over here between these two markets. So this is presumably something that is reasonably well known. And unless there are questions, I'll move right on to talk about implied volatility. So many of you may know this, but for the others, what in the world is implied volatility? What implied volatility is a measure of volatility that we extract from option prices. So option prices, you may or may not have had this described to you. An option, in this case a call option, is the right, but not the obligation, to buy an asset for a fixed price at a pre-specified point in time. And this is the boomerang or hockey stick payoff that we have for option prices. That's all great, but what we want from options here is really something that we extract, that we elicit from option prices, and that is this forward-looking implied volatility. So we like to talk about historical volatility, which is in the past, the standard deviation of the rate of return. Implied volatility, ladies and gentlemen, is different from the realized rates of return. It is inferred from, extracted from option prices using the Black-Scholes model. It is in that sense that it is implied. It is implied in option prices. You might say, how in the world is it implied? Well, it's implied in the sense that it's the answer to the following question. If the markets are using Black-Scholes to price options, what volatility must they be using? It is, in other words, the sole My apologies, colleagues. It is the answer to the question, what is the volatility that must be input into the Black-Scholes option pricing model for it to give us the market price of the option we observe? So I hope you can see from that description, you need to be able to observe the option price, you need to observe the price of the underlying security, and then you can use the option pricing model to elicit this implied volatility. What is the big deal about implied volatility? The big deal is that it's forward-looking. It's looking from today to the expiration date of the option. It's called the fear index. I prefer nervousness and uncertainty because fear may be irrational, but nervousness and uncertainty are clearly rational reactions to events. But this is the Vixx index that is traded on the S&P 500. I have here a page that shows you Vixx going back to the 1990s. Regrettably, I don't have time to go through this with you at this time, but I hope you can see some of the crises through which the world has gone through over this 17-year period from 1990 to 2007. What I do want to show you is the Vixx over two specific crises. The two specific crises I have in mind are 1991 and 2003. Can you think, ladies and gentlemen, what happened in the world over those two periods that makes them especially comparable? So what happened over 1991 and 2003 that makes these periods very comparable in terms of the events that were going on in the world at that point in time? Anyone want to take a shot at that?
Don't be shy. If you like
Excellent.
get your comments, just raise your hand.
I'm going to introduce a little bit more attention and
1991 is the end of the Cold War.
That's true.
Yeah,
That-
and meanwhile, you had the beginning of the first Gulf War.
There we
Yeah, and then Iraq, the Iraq no-fly zone also marked at that time. The Persian Gulf area was it's very unstable.
Yes. So that's very good. It has to do with the Persian Gulf. It's what I call Persian Gulf I and Persian Gulf II. Persian Gulf I was the invasion of the Emirate of Kuwait in August of 1990, and Persian Gulf II was the events in Iraq in the spring of 2003. Here's what I want to show you, ladies and gentlemen. Here's what's interesting. I'm going to zoom in on the high water mark in 1991 and in 2003. Do you see what these two are telling us? The maximal point of uncertainty in both Persian Gulf I and Persian Gulf II was almost exactly the same. Now, I'm not a political scientist, but what this is telling me is that markets were equally nervous at the high water mark in both of these events. And the reason I trouble you, excuse me, the reason I trouble you with all this, ladies and gentlemen, is that for me, VIX is an excellent measure of comparison of crises across different types. These happen to be both political crises, but I want you to think beyond that. Just think beyond that of the kinds of crises through which we've gone through and which this allows us to measure. So the natural one then is the Great Recession, right? 2007, 2009. You can see here 80.86% was the high point there, much higher than in Persian Gulf I or Persian Gulf II. Is this the all-time high? Well, if I ask that question, the answer is probably no. And it is true that it was exceeded in the current crisis, but believe it or not, the current crisis is also not the all-time high. The all-time high, and this is almost unfair to ask, so I won't, the all-time high was in October 19th, 1987, when, because of the stock market crash that day, implied volatility went up to 150%. And fortunately, we didn't challenge that record, even in the current crisis. Taking you back to the current crisis, the high water mark here thus far, and hopefully we're on the way to recovery, but thus far anyway, has been on March 16th when it was 82.69. So remember, 82.69 is greater than the Great Recession that you see over here. So at the peak, at least the peak thus far, was higher than the peak back during the Great Recession. So that's the way I like to look at these measures of comparison. And the other thing I did for you, as you can see here, is to compare and contrast VIX with V1X. I know it's a little difficult to read this, but this is V1X and this is VIX over here. Remember, V1X is the one on the German Stock Exchange. And so you can see, unsurprisingly, that the rise and then the recovery have been about the same and around the same time. You can see that V1X was a little bit higher, 86%, and V1X, I already told you, peaked out at 82.69% back in March. So again, you can see markets reacting in similar way and then to some extent recovering in similar ways as well, although obviously not identically, as you move forward over here. Here's what I want to share with you. Here is what I want to share with you, ladies and gentlemen, on what I call the term structure of VIX. Remember, this is a term which I referred at the outset. What the term structure of VIX refers to, it's really a fancy way of saying what is the implied volatility by time to maturity. And so VIX is a 30-day implied volatility, but then you can see that we have options trading out as far as 2 years and longer. And so what we can do here is we can plot the implied volatility by time. And what I really would like you to see is the differential ways in which we can observe the term structure of implied volatility across this period. I begin back in the time of calm. So February 14th of this year, you see a low level of implied volatility and a slightly upward sloping turn structure. That's what we call normal, ladies and gentlemen. What is clearly a crisis is the peak, which was, as you can see here, March 16th. You see here it's a downward sloping turn structure. What markets are telling you now is that they're super nervous now, and at some point we're going to work our way out of this, but you can see that it is elevated throughout, both the short end and long end, but the point is that the short end is higher than the longer end. And now I bring you to what I did several days ago. On May 14th, you can see sort of where we are now. We're on our way back down to normalcy. We haven't quite gotten there. And if you look carefully, you can see that it is still a little bit humped in terms of the turn structure. So what's interesting, ladies and gentlemen, is not just the level of VIX, of which I'm very fond of looking at, it's the turn structure of VIX. What I wanted to show you also is the turn structure of VIX. Can you imagine what date I'm going to take you to? The date I'm going to take you to, which you may have seen if you've looked one page ahead, is November of 2008. November 20th, 2008. The reason I take you there is I wanted to show you another crisis in which VIX was very elevated, and what is true about the turn structure, it is indeed downward sloping, as you see it over here, very similar to what you saw in March over here. Okay, so you may ask, why did I not put all of this on one slide? The reason is that Bloomberg is no longer reporting the turn structure of VIX going back to November of 2008. So what you have here is a document that you should preserve, because this is one of the few places that you can still see this, or at least out of Bloomberg, you can't see it anymore. But I share this with you. It's a collector's item, is the only way I can describe it. But the point I really wanted to make, more seriously, is that the turn structure of VIX back in November of 2008, that was the peak of the Great Recession, was similar to what it was during the peak of this, or at least the peak thus far. And again, we're on our way down back towards, hopefully, normalcy as we work our way out of this situation in which we find ourselves. Okay. One point about credit markets, and I'll get off of this. This is the high yield corporate sector in the US. It's the yield to maturity. Obviously, prices go down as yields go up. You can see here that it peaked around the same time period as the equity markets bottomed out and VIX peaked. This is March 23rd at 12.4%. It had started out with 5.6%. So yields clearly went up dramatically as the concern about default went up. You may recall that the Federal Reserve stepped in with a buying program over here. So that is partly the reason why yields started coming back down. But anyway, I wanted to show you very briefly the yield on the US corporate high sector as yet another measure of how markets were reacting over the past 3 months. All right, let's go back to oil. What I have for you here is, as I say here, a contrast of Q1 2020, so ending in March, with the Great Recession. This is a comparison of VIX, OVX, not VIX, OVX. You can see that during the Great Recession, it peaked at 100.4%. Remember, VIX peaked at 80.9%. During this one, it went far higher. So people were super nervous about what was happening to oil markets. You probably know that. Prices crashed. They crashed in both of these. They crashed even more back in the Great Recession. We fell more than $100 from 145 to 34. We had never fallen $100 before in oil markets because we'd never traded above $100 before. So that was a big decline. Here they declined as well. I'm looking at the WTI futures contract here. You may know, ladies and gentlemen, there are two major futures contracts. There's WTI that's delivered in Cushing, Oklahoma, and there's the Brent North Sea, which is delivered off of a Scottish island by the name of Solemn Voe. I'm going to focus on WTI. When we talk about this in the fall, I'll talk about the Brent contract as well. But for now, let's stay with the WTI, the North American Futures Contract. Here's one important thing I want to focus on in just a moment. The slope of the curve, ladies and gentlemen, changed dramatically, and it does so whenever we have a sharp decline in demand and or a surge in supply. So I want to show you that up close and personal. And finally, take a moment of your time to talk about the equity prices of 8 major oil companies. They obviously fell in response to both the markets and oil prices coming down. All right, so let's look at some of this in greater detail. Here you see a comparison. This is again is a Bloomberg screen. So I'm contrasting CL1 with CO1. You might say, what in the world are these? CL1 is the prompt month contract for WTI, the North American contract. CO1 is the prompt month contract, the one closest to maturity, over in the Brent contract, the one that's delivered in the North Sea. You can see that they track each other reasonably closely. Brent is trading at a premium to WTI. This is that one cataclysmic day, and I don't want to make too much of this. There was one day when WTI went negative and then it recovered. The reason it went negative is that if you don't get out of the contract before it closes, you have to take delivery of it in Cushing, Oklahoma. If you have nowhere to store it in Cushing, you're in trouble. So people had to leave out. They should have left earlier, but they had to get out. And so they were willing to pay someone to get it off their hands, and that was a costly thing. So you have to remember, people speculate in these things. There's nothing wrong with speculation, but you occasionally can get caught in this kind of situation where there was simply nowhere in Cushing, Oklahoma to store this oil, so it went negative for one day. Let's not make too much of this deal. It happened once, but I think I don't want to exaggerate the import of that one event.
If I could interrupt and just ask a question.
Please.
Yeah.
Is there a way of to see now?
The question actually came in from Farid, and
yes, please.
The question basically referred to one of the previous slides.
Sure.
The question refers to one of the previous slides and a comment you mentioned on. Basically, does the observations that you mean that you said mean that the market is always overreacting and that it's always recovering faster than expected, and that any crisis is for sure a good investment opportunity?
Okay, so I want to be very careful about. There's a couple of very good questions in that. The first answer is, in my view, ladies and gentlemen, markets never underreact and overreact. I know that sounds like a strong statement, but permit me to explain. What I am saying in that, ladies and gentlemen, is that markets attempt to do the best they can at understanding the situation. And with your permission, I'm going to give an example that I hope no one will be offended by. I want to give the example of July 7, 2007, which people in London called their 9/11. If you remember, what happened there was the following. There were explosions in which people died in the London Underground. I'm by no means minimizing that. I'm going to talk only about the financial implications. What happened on that day? On that day, as that news came out, both the London market and the New York markets fell. They both fell because obviously this was bad news. By the end of the day, New York had recovered and ended up with a small positive value. London had recovered as well, but still ended up in the negative. You might ask, what in the world has that got to do with this? The point is, when that news came in, markets were not able to know whether this was a one-time event and whether there was anything biological or chemical in it. In some sense, the knowledge that it was a one-time event, there was no extraordinary measures used, that was quote unquote good news. I use that very tentatively because, again, I realize it was bad news. But relative to the original concern, there was some positivity to it. How does that relate to this? Markets initially didn't know what kind of attack it would be. They made their best guess at it. As the information came in, they adjusted. So that pertains to my answer to your question. I don't think markets underreact or overreact. at any point in time, they're trying to do the best they can under the situation and with the information that they have. Now, the second thing is, when is this a buying opportunity? Well, obviously, ex post November 2008 was a tremendous buying opportunity. But remember, you have to have what I like to call the financial and intestinal fortitude to step up and buy when everybody else is heading out the door. So yes, you will be compensated for bearing risk on average, but you may suffer losses that are large as well. I do believe that expected rates of return go up when VIX goes up, but again, then bear in mind, so does the risk. So thank you for that question. I hope I was able to explain my answer, and I would be absolutely delighted to have follow-up now or at the end or whenever Anna wants to interpose. Right, so we were over here. Yes, so hearing no other questions, let me go on, ladies and gentlemen, and talk about this slide over here. Let me tell you what I'm portraying here. I am showing you the entire futures curve at 4 different points in time. What do I mean by the entire futures curve? It means prices of futures contracts all the way 8-9 years into the future. So when we trade oil, as I think you know, we don't just trade 1 or 2 months out, we trade it all the way 8-9 years out. Therefore, it is particularly interesting to see the level and the slope of prices looking down 8-9 years. Let me begin with the Great Recession. The first thing to note is obviously prices came down, but the other important thing to note is we went from what markets called backwardation, and I'll have occasion to describe this to you more fully in the fall. We went from backwardation to contango, which are fancy ways of saying that this is a downward sloping, was really humped, but a downward sloping futures curve to an upward sloping futures curve. What's happening here is this. In the short term, prices are really depressed by a combination of either lower demand and or excessive supply. Longer term, they expect that there will be some form of recovery, and so you see the contango curve over here. Something almost identical happened over the past 3 months. This is the curve on January 16th, backwardated curve, downward sloping. This is the curve today. In contango, interestingly, the prices over here are actually higher than they were in January. So again, markets are responding to the supply and demand effects. Prices are low, but you see the curve upward sloping. And it is incredibly interesting to see this as a manifestation of the fact that we are currently, as we all know, in a supply and demand crisis situation. So, slope of the curve, another important takeaway there.
Do you think that the slides show that the decarbonization of Europe and North America will not hit the oil sales?
You know, that is a more difficult question to handle. Let me say the following. And I'm going to talk about decarbonization a little bit as well. But before I do that, let me talk about markets. Markets are attempting to take all of that information into account as they depict these prices. So I'm not saying that this is different from 2008 in that sense. They are obviously accumulating all the information and thinking about whether or not we have hit what some people called peak demand for oil. And here I'm going to venture a little bit into more dangerous territory about whether or not we have hit that peak. There's a lot of use for oil products, ladies and gentlemen. They're not just in cars. They are mostly in transportation, but they're also in the chemical industry. They are in airline transportation. I don't know how we can decarbonize that. They are in marine, in bunker fuel and things like that. Again, these are not, bunker fuel is not huge demand, but jet fuel consumption is significant. Hopefully, we'll get back to some reasonable jet airline transportation. So if you look at these things, there still is going to be significant use for oil. And at the risk of impugning my reputation, let me invite you to look at some of the forecasts that people have made about oil demand in the future. The most obvious one is the Energy Information Administration, which is an agency of the Department of Energy. The less obvious ones, and maybe you might say they're biased, is those of the oil companies who project oil demand into the future. I'm not saying they don't have their perspective, but at least it's worth looking at what they think will be the demand for oil in the future, for fossil fuels in general in the future, both in Europe and the US. So it's a good question. I hope I wasn't evasive, but forthcoming in terms of giving you the answers to those aspects. So thank you. Right, I've already spoken about OVX. OVX is the 30-day implied volatility in the oil markets. This you can see is absolutely stratospheric. I mean, we have never been above 100, and again, this is now in April. We actually hit 325%. So super nervousness again. April 21st was that day when it went negative and people sort of went almost apocalyptic on us. But it's come down since then, and it's still very, very high, but it's not nearly as high as it was back on the 21st of April. So this is implied volatility in the oil markets, a very interesting forward-looking indicator of nervousness and uncertainty. What I want to share with you here, and I think you could probably guess already what this is. What this is, ladies and gentlemen, is the term structure of volatility for the oil markets. Remember I spoke about the term structure of Vix? Well, this is, in a sense, the term structure of OVX. It is the implied volatility on oil markets looking into the future. And here, permit me to take a couple minutes of your time. I want to focus on 3 different dates here and talk a little bit about what this is. So, sorry, this is not the term structure of Vix. I misspoke. This is the vol skew in OVX. One of the conventions I make in my classes is I never make a mistake. I'm only doing it to see if you're following me. That joke sometimes works, sometimes doesn't. I don't know if it's worked here. Anyway, this is the vol skew in OVX. So what am I showing you here? Let me first talk about the horizontal axis. The horizontal axis, ladies and gentlemen, is what we call moneyness, which is the ratio of the strike price of the option to the futures contract. And then what we're depicting in the graph itself, is the implied volatility of options all maturing on a given date, but with different strike prices. Okay, let me say this again. The 3 lines that you see here are implied volatilities. They're for options that expire on a given date. You can see the dates over here. And they depict those implied volatilities by those different strike prices. So for example, let me take the current date, which is May 18th, 2020. The options contract all expire for the July contract, which actually happens in the 3rd week of June. So this is the current vol skew for options on the July futures contract, which expire in June. I know it's a little confusing, but the options on the futures contract expire before the month in which the oil gets delivered. Now, what am I showing you here? Well, what I'm showing you here is, as I said, the vol skew across these 3 different dates. What you can see is that implied volatility differs by moneyness. You might say, what is it that's the message that's being conveyed here? The higher is the implied volatility, the greater is the concern that we might go in a sudden move in this direction over here. And so what the vol skew is depicting for you is a concern about spikes or crashes in oil prices. The fact that implied volatility was far higher at the lower strike prices back on April 21st, 2020, says to you that on that date, markets were very concerned that oil prices might do what? They might crash. The concern here is still very similar, but now there's a little bit of an upswing where there's some positivity, there's some possibility that oil prices might spike. That hasn't been a concern up until now. It's beginning to make its way a little bit into the markets. But perhaps the most interesting date which I can share with you here is January 3rd, 2020, which is the red line down here. In the red line down here, I know it's a little difficult to see, this right side is a little bit higher than the left side over here. In other words, on that date, the 3rd of January of this year, before any of this began, the markets were more concerned about a spike than they were about a crash. The question you want to ask yourselves, ladies and gentlemen, is why was that the case on January 3rd? We will take here, Anna, what we call a pregnant pause to see if anyone can guess what the reason is. And as you think about it, ladies and gentlemen, you think about what happened on January 3rd that might give you pause to be concerned about a spike in oil prices. Anyone at all, ladies and gentlemen? I'm not sure how long to go for a pregnant pause here. Okay, so what happened on the 3rd of January was there was a bombing attack on the Baghdad airport by some units of the United States Air Force. And because of that, there was some concern that perhaps there might be a possibility of hostilities in the Persian Gulf between the US and Iran. That didn't materialize, but there was some concern that that might happen. While that concern was ongoing, you can see that markets were saying, well, you know, there might be a spike in oil prices if this issue gets out of hand, and I'm not making light of that issue. If this issue gets out of hand, there might be a spike in oil price. Again, that didn't happen, and so markets went back to worrying about a crash, but you can see that markets are able to make that distinction. They are able to discern what I call demand side effects from what in this case would be supply side effects of a restriction in supplies coming to the world consuming markets from the Persian Gulf. So I think the vol skew is a particularly interesting way of both seeing how we're hopefully on our way back from this crisis in the difference between the green and the white lines, but also in our ability to discern, to be able to elicit, to be able to see when markets are concerned about a spike relative to when they're concerned about a crash.
Professor,
Please, please.
I have a question. On the 3rd of January, the Iranian general was murdered by the US.
Yes.
So if I look at the chart right now, there's a very odd situation in the market that few days. The day he was killed, the next day price went up a bit.
Right. But this is more than that. Sorry, go ahead.
Yeah.
I didn't mean to interrupt. Please proceed.
No, I just have a question because when we talk about the options, there are 4 directions of the options as well. Depends on the risk profile of the investors. So how does these 2 events collide with each other, and how do we explain the situation that oil price rise after the killing of the top Iranian general in Iraq, which is that day that you just point out?
Right. So there were 2 things that happened. Prices moved up that is the denominator over here. By the denominator, I simply mean the denominator here of the futures price. But I wanted you to see more than that. What I wanted you to see was that even after adjusting for the oil futures price change, option prices themselves were trying to make a guess at what would happen going forward. And what they were saying at the time with this little, with this bias to the right is there might be a follow-up to these events that would cause prices to spike. And so they bid up the implied volatility over here relative to the implied volatility over here. So I hope I'm answering your question. The first part of your question was oil prices moved. No question about it. That's the denominator. Now we're going to see, well, from here on, where do we go? What is our best guess at what might happen? The answer is oil markets were telling you, yes, there is much more of a concern today, i.e. January 3rd, about a subsequent spike than there was at the end of December. That is the information that I'm attempting to elicit from the volatility skew that you see here. And please tell me if I've responded to your question or not.
Yeah, thank you. And can you explain us more about the out of the money, the money option?
Yes. Anna, you're going to have to give me more time because there's a question here. So I'm going to take you.
Excuse me, Professor, just otherwise I'm afraid I remain behind. Sorry, can you kindly remind me what is on the horizontal axis?
Yes,
the chart.
Certainly. Thank you for following it up. Again, we'll have more time to do this in the fall, but the horizontal axis is what we call moneyness. It is the ratio of the strike price of the option to the futures contract. So if I can explain that a little bit more, when you see 60% over here, it means this option has a strike price of only 60% of the prevailing futures price. At the money options would be 100% would be around over here. These are options that have strike prices above the current value of the futures contract.
The option is the spot price? No.
The option is on a futures contract. So one of the important points that I will be making in the fall again is that the options that we trade in commodities are all of them, or almost all of them, on futures contracts. In that sense, they differ from options on equities, which are on the spot price. So therein lies a difference. The options that we trade, I know I'm repeating myself, but for emphasis, permit me. The options that we trade on oil is always on the futures contracts for the different maturities that these exist. What I'm showing you, yes, well, that's what I'm showing you. So hopefully, so Anna, this is where you're going to hopefully give me a couple more minutes. What I'm showing you here, and I'm doing this for emphasis, but permit me to do that. This, ladies and gentlemen, is the equity volatility skew on the S&P 500. The equity volatility. So what are you seeing? What you're seeing here is that in equities, what is the concern if there is a large move? If there is a large move in equities, regrettably, it is always to the downside, right? We have panic sells, we have very few panic buys. If you, ladies and gentlemen, wanted to start a panic buy, all the more power to you. But as I said, we have very few panic buys. We have panic sells in the equity market. What I wanted you to see is that in the equity markets options, the vol skew is what we call a sneer. It's a downward sloping line. In general, and I know you're not seeing it here, in general in commodities, we actually see a U-shaped structure. I don't know if I have time to get this up and running. Take my word for it. You see a U-shaped structure of the kind you see over here, where in oil markets, you're concerned about both a spike and a crash. In these times of crisis, we're concerned predominantly on one or the other. So what I'm saying here is that in going from April to the current time, we're going back to more or less a normal time where we will have concern about both spikes and crashes. And what I wanted to emphasize back in January was that that was a time at which we were, at least for that short period, more concerned about a spike than we were a crash. I hope that's responsive to the questions I've been asked. But one of the things that I'd like to draw out a little bit more when we have time in the fall is to show you what I hope you can see to some extent, the difference between the vol skew in the equity markets versus the vol skew in the commodity markets, such as oil. Okay. If they're not, I'll go on here. This Biz Oil P index, let me just define that for you. Biz Oil P is an index of 8 large oil companies. And they're basically the usual suspects here. So Exxon, Chevron, Conoco, the big oil companies over here. This, what you're seeing here, ladies and gentlemen, is an index of these oil equity prices. So you can see here the crash from February through the May period. You see here the precipitous decline, and then the recovery such as we've had today. These are in index points, so just a measure of oil equities. Okay. I do want to talk about, in the time that I have remaining, two or three more issues. Two more issues. One is what I said at the outset. I wanted to try to distinguish between the supply and demand side aspects. Remember, this issue over here. Can we empirically distinguish between supply and demand side aspects? The way I'm going to try to do that is by looking at the correlation between the rates of return of oil prices and the S&P 500 index. So remember what correlation is? It's a measure of co-movement. Correlation of +1 means they always move in the same direction. Correlation of -1, they always move in opposite direction. 0 means they're independent. I'm showing you the correlation between oil prices and equities going back essentially to the Great Recession. What I wanted you to see here is that the demand side effect of the Great Recession was to have a strong positive correlation between oil prices and equity prices. And this is a very interesting phenomenon over here. We don't have time to talk about it, but you might ask yourself why it was negative over this period for a short period of time. What I want to focus on here is the correlation between oil prices and equity prices during the Great Recession was strongly positive. What complicates our analysis here is what? What complicates our analysis today is that we have a demand side crisis, that's the obvious one, but we also have this competition that existed at least for a while, maybe still does, between the Kingdom of Saudi Arabia and the Russian Federation on output. And the really interesting thing that I see in this, ladies and gentlemen, is the fact that correlations here are surprisingly low. My interpretation of this is that a lot of the current crisis is a supply-driven kind of thing, not just the demand side, which is obviously crashed. So you may accuse me of overreading it, and I'm not unsympathetic to that criticism, but I did want to show you one, I think, interesting indicator of how much the oil price collapse is demand-driven. Again, the obvious one, how much may be driven by the behind-the-scenes confrontation between these two major oil producers. So that's what I wanted to share with you there. The next, and just two more topics, and then any Q&A or so, I'll be happy to. What I'm showing you here is what? What I'm showing you here are price forecasts. You might say, who is doing these price forecasts? Well, these people over here are doing the price forecasting of where they think oil prices will be as of what? The second quarter of this year, the third, the fourth, and out into 2021. Here's what's interesting, ladies and gentlemen. Look at this line over here. What this line over here tells you, is the difference between the median price forecast and currently observable futures prices for that time period. So what these people are telling you is that they are bullish on prices relative to the futures prices that we're observing. What does that mean? To me, it means that if and when we get beyond this point, prices will be above where futures prices are today. You might say, well, that's obvious, but you can see here people whose job it is, at least in part, to look at this. That is what they're telling us, is that anywhere from $2 to $12 higher than where oil prices were when I did this a couple of days ago. So again, this is a forward-looking forecast, so it's not markets, but it is the forecast relative to markets that I find both informative and interesting, and I wanted you to see that over here. Again, any questions at all, Anna, don't hesitate to interrupt. The last thing, if I may end on an optimistic note, is I wanted to show you the natural gas futures curve. Well, what is the natural gas futures curve? Well, it's quite comparable to the oil one, except that this is looking at natural gas as traded in the continental US. The delivery point on this is, some of you may know this, Henry Hub in the southern part of the state of Louisiana. My point is not so much to focus on the natural gas market per se, it's to show you where I think there is a point for some optimism in where we stand today, and hopefully we all stay healthy and safe. The first thing to note is that there is this sawtooth pattern which you see here. There's nothing mysterious about that, ladies and gentlemen. That is a manifestation of, can someone guess what that is? The sawtooth pattern over here in natural gas?
Is the seasonality?
Seasonality. Thank you. Very good. 2 points on the exam. I can't promise that, but exactly. It's it is seasonality. So we have seasonality in natural gas prices, which are higher in the winter than they are in the shoulder months. And that's because simply, ladies and gentlemen, we take gas out of storage because we want to make sure that people in the northeastern and the midwestern part of this country can heat and cook and so forth. Okay, I don't want to talk about seasonality. What I do want to talk about is the coming winter season. Do you see why I am optimistic? Not just about natural gas, why I'm optimistic in terms of what the futures curve is saying about natural gas prices this coming winter season relative to the winter seasons in the future. I'll pause again to let that sink in. You see this, ladies and gentlemen? Prices for the coming winter season are above trend. They're above trend in the sense that, well, there could be a number of reasons. One is weather-related reasons. I don't know of anything of the coming winter that would drive that. My hope is that this reflects an anticipation of what? A resurgence in manufacturing activity. If there is this resurgence in manufacturing activity, that will draw down more natural gas than had been expected to be drawn down, and that will push prices up. So that is my source of some optimism that I see in the natural gas futures curve as portrayed at this point in time. And I think on that optimistic note, I have two more things to say before I get yanked out of here. The first thing is that I would very much like you to remember, ladies and gentlemen, that prices are not just trading vehicles. Prices are conveyors of information. They tell us something about the world. They're not just for risk management and trading and speculation. They're good for all of that. They are also providing us a message. And permit me here a quote from one of the earlier Nobel Prize winners, Friedrich Hayek, who said in 1945, who wrote, "Fundamentally, we must look at the price system as a mechanism for communicating information." So that is what I hope I was able to bring out to you in my discussion. The second quote is from a very well-known corporate finance textbook. Again, if markets are efficient in processing information, if they accurately impound available information, the challenge to us is to read the entrails. Well, reading the entrails is something that comes from the religion of ancient Rome, where prophecy was related to the inspection of the entrails or intestines of sacred animals. The point is that the challenge for us is to elicit the information that they're providing us about the future, because that's one of the very important things that they do. And then finally, going back to what I said earlier about markets not being perfect forecasters, there's this well-known quip from Paul Samuelson that the stock market has forecast 9 of the past 5 recessions. It's a joke that's meant to say, look, they're doing the best they can. They don't always get it right, but the challenge to us is at least to understand what it is that they're telling us, and hopefully I was able to provide some interesting interests on that. Let me conclude. I won't take up your time on this, but this, ladies and gentlemen, is what I would like to do in the fall when we reconvene, hopefully in Houston, if not in Vienna. In presenting these to you, I would like to go over sort of a version of what I did today, but a little bit more detailed about what it is that's happened to markets since our meeting here in May. It's only 2 months down, so we'll see how many developments there are. I'll talk about the linear and nonlinear instruments. So the linear instruments are the forwards, futures, and swaps. I'll talk about option prices. I'd like to share with you a little bit about how we calculate implied volatility for those of you who have not seen that up close and personal. I'd like to talk a little bit about volatility and correlation. Again, I think I've given you some snippets of that in my presentation today. I'd like to get into that a little bit more, talk about historical and implied volatility, what the relationship is between these two. Hope to have a chance to present that to you, and then talk a little bit about the correlations. I will conclude my September presentation by something I've not had a chance to talk about at all today, which is structured derivative products in energy. Let me say one sentence about this, and then I will get off and answer any questions you may have. The nice thing about structured products in energy is that they respond to the kinds of needs that we see industry having. The example I like to cite is an average style option. So you might say, well, these exotic options are out there. Yes, we have some exotic options, but I would submit to you, in contrast to equities, these exotic options have a natural raison d'etre. They have a good reason for existence, and so I would very much like to present that to you when we convene in, I guess it's almost only 2 months from today. So with that, Anna, I return the baton to you with thanks for your assistance and that of your colleagues, and I'd be delighted to stick around if there are any follow-up questions at this time.
Professor?
Please.
Yeah, I have a question. There's a high correlation between the gas and the oil price. There are a lot of gas export country talking about they would like to set up a their own index with the concept of the similar to OPEC basket. What is your view on this? And does it really make sense they unpack or the pack situation is better? Thank you.
Sure, that's a very good question. That's a little bit more difficult, but I'll try to give it my best shot. I think one of the interesting things we've seen is that the natural gas market is no longer just the continental market that we have seen up until now. So we've seen more exports coming from the U.S. to Asia as well as Europe. And I think that's making the market a little bit more commoditized. It had been much more of a continental market. So I'm suspecting that the correlation will probably tighten as these things go into effect. Again, as I think you know, sounds like you've been in this industry, it's not cheap to do these kinds of things. It requires liquefaction plants on one end, regasification plants on the other, and trains of tankers, some of which obviously exist. Just to show you here, and this is not directly responsive to your question, I think, but between natural gas and oil, I'm showing you the correlation over here. This is a little bit higher than I've seen it in the past. In fact, if I go back to, I don't know if I can go back to 2000, the prices sometimes are, we did have a high correlation in some periods, but sometimes, as you can see, it's been negative. But to answer your question directly, I think that it's likely they will be tightened. Is it a good idea to have additional markets? It's always a good idea to have additional markets for which there will be competition. And I think you're still going to have to challenge or to overcome this challenge of the cost of bringing natural gas either from the Middle East or from Russia or from the US into either Europe or Asia. Those costs can be anywhere from $1.50 to $3 per MMBTU, which is the way that's measured. It's probably easier within Europe because the costs there are not as significant if you can use pipelines, which are available. So I'm not sure if I've answered your question, but I think it will be interesting to see where the natural gas markets go in the future.
Mark, it's Farid here. I had a follow-up question which I asked Anna to run by. Professor Ronn, with regards to my question about the market crashes and the investment opportunities. So the follow-up question is, considering your comment about the fact that the market will never overreact and underreact and operates with all the relevant information, what is really like a rationale for the quick recovery that we see now, when we know and when everybody is actually expecting a huge drop in the revenues and profits by Q2, Q3, and also there's a fact that this situation with the virus is not even close to conclusion. There is South America which is picking up, etc., etc.
Yeah, it's a little difficult for me to say why markets are optimistic. Maybe they have their separate sense of where this will go. I did want to mention one thing. Farshid, is it? I did want to mention one thing in terms of market, well, let me say it more precisely. So this goes back to what I was saying, you may recall, about the investment opportunity back in November of 2008 and how you might want to think about this in your own investment portfolio. So what I look at in terms of expected rates of return is the current value of VIX. And the reason I do that if I can take a moment of your time on this. I'm going to write down the Sharpe ratio, which you may know, at least in the US, the equity market is about 0.4. So what is the Sharpe ratio? It's the expected return minus the risk-free rate divided by volatility. So do you see how I use this? The way I use this is if you set this equal to 0.4. Now I think maybe you can see how I use the implied volatility. I multiplied by implied volatility here, and now what I get is that the expected rate of return on equities.
Professor Ehud, Ronn.
Oh, I'm not showing this. Thank you.
Yep.
Yeah. If I had a dime for every time that happens to me, Anna, I would be a wealthy person. Yes. Sorry. So let me back up here. What you have here in the Sharpe ratio is the expected return on equities minus the risk-free rate divided by, yeah, this is something I know, divided by volatility. And this, as I think my colleagues in finance have told you, let's say that's 0.4 using long-term US data. So now getting back to the issue that I was asked about, how do we use this information to make investment decisions? Well, multiply this through here. What you now have is that the expected return on equities is equal to, and then transpose the risk-free rate to the right-hand side. What you have here is what? What you have on the right-hand side is the risk-free rate plus 0.4 times fighting me here, 0.4 times volatility. Now, do you see how this is? So if you take volatility to be Vix, then you can see that the expected return on equity is equal to, risk-free rate is what? Well, it's about 0, right? So let's ignore that. Plus 0.4 times, what did I say Vix is now? 32.94%. So the risk premium right now is about 13%, assuming the risk-free rate is 0. The point of all of this is that if you assume the Sharpe ratio is approximately constant over long periods of time, you can use Vix to determine what the current risk premium is. So I'm not saying that markets don't tell us at all about this. They tell us what the current risk premium is. Of course, there's a lot of risk if you were to buy equities right now. And that was even more so if you were willing to buy equities when volatility was at the 100% mark or higher, the 82.69% mark that it was. So to summarize, I'm saying that we can learn something about what markets are telling us in terms of determining the risk premium. Is this enough for you to get into markets right now? That's something you have to decide. The point is, this is what markets may be compensating you if you buy equities right now. As to why markets have recovered as much as they have relative to the bad news that we may be hearing from some epidemiologists, that's beyond my purview. Markets are trying to do the best they can in terms of assessing where they think things are going to be going into the future.
All right, and we had a further question coming up from our audience. I believe that Fahid's question has been answered. If not, just let us know or hit us back with a further follow-up question.
Sure.
But Jana was wondering if somehow the cheap oil prices, which do cause deflation if the price of oil-based products could cause deflation, excuse me, if the price of oil-based products decreases, this situation is basically very hard to ignore. And would the situation of low oil prices somehow be a positive outcome for renewable energy or electric cars?
Yeah, that's the second part is very difficult, Anna, but let me give a shot to the first one. This is something I can't resist showing you, so I'm not going to resist it. What we have in several markets, both here as well as in Europe, I don't know if you've ever seen this, ladies and gentlemen. What this is what we call the break-even rate of inflation. So what is the break-even rate of inflation? Well, what the break-even rate of inflation is, it is the difference between the nominal 5-year rate and the real 5-year rate. And so if I take you here back to February, you can see that the initial reaction of markets was sort of a reaction of what you might expect from a depression or a recession. During a depression or recession, what do we get? We get lower consumer prices. And so the 5-year average consumer price index expected rate of growth went from 1.65% to as low as 0.12% over here. Since then, it's recovered to some extent, and now this is the 5-year rate of inflation of 0.83%. So obviously, it's only half of what it was before the onset of this crisis. So one way to summarize the answer, and it's not exactly oil-based answer, but it's a summary answer, is, at least with respect to US CPI prices, you can see that the rate of inflation is lower than it was before the onset of all of this. You might also ask me why it is higher than the 0.12% that we're seeing over here. I could try to show you the same numbers in Germany, but there I'm not as conversant with the Bloomberg ticker symbol, so I don't want to hold us up, but I suspect you'll see something similar if you look at German break-even rates of inflation. So the short answer is the break-even rate of inflation for the next 5 years looks a lot lower than it was before the onset of this. Usually that's attributable to recession-type lower demand that causes consumer price index not to go up as much. The question of what this will do to renewables, that is regrettably a little bit outside my purview. I don't follow those as closely because regrettably, those markets are not as liquid as the markets that I follow. So it's a good question of whether this will be additional incentive or disincentive given their low levels. But let me leave that to folks who worry about that full time.
And all right, so I hope that answers your question, Bojana. Another question that came up from Anna Karabach is basically the question was, is it risky to eliminate physical oil deliveries and swap them for purely financial instruments?
Oh, that's a good question. That's a good question. So let me answer that by taking you back to where the cause of, I think, that question was, which was this issue over here. So I think my answer is at least several dimensions. The first is that people who hold these oil contracts do need to take physical delivery. So someone at the other end is going to have to take it. And so they have to have storage for that either in Cushing, Oklahoma, or off the Scottish island Solemn Voe in the North Sea. Many people close out their positions before they get to this so that they're not confronted with this issue of physical delivery. And what happened to these good people over here is they waited too long to close out, and they were probably squeezed a little bit because they had to get out at almost any price. But I do want to assure you that the WTI contract and the Brent North Sea contract are both physical delivery contracts. Should we be concerned that other people are in this? I think not. These other people may have some exposure to oil prices, but perhaps not at Cushing or at Solemn Voe, and they still want to hedge their exposure. They just need to remember to get out of it in a timely manner. So these are physical delivery contracts. I do want to assure you on that point. I hope that's responsive to that question, but I'll leave it to a follow-up if it's
not. All right, I think that answered the question quite well. If not, Anna, let us know. Oh, she's saying thank you very much.
Thank you.
And we also had a few people who have been thanking you for the presentation. And yeah, so keep it up, keep it up. We still have time for your questions. And so, dear listeners, keep them coming. Do you recognize a few of your students' voices?
You know, Anna, I don't know if I've had the privilege of seeing these good people yet. Mac may know far better. Obviously, I had the privilege of speaking to their previous cohort last September, but I don't know if I've had the privilege of meeting these good people yet, and I'm certainly looking forward to that, hopefully in September.
So one of our students who posed a lot of questions already was Farid. He was last year with you also in the US. So
okay.
I saw that he already posed 1 or 2 questions, and
good to hear from you, Farid. Thank you.
A lot of other students who are in this year's class have already also posed some questions. So
okay.
Yes.
Thank you, Mac, and thank you, Farid, for the questions.
Yeah, and a few people are writing that they're very excited to see you in September. So how does it look? Mac, I guess the decision, if it's either in Vienna or in Texas, will be taken at a later date.
Yes. So in the end of May, beginning of June, we will set this for sure. If we're gonna stay in Vienna or do it in the US. Right now it looks more like this year it will be in Vienna, but the final decision is to be made soon.
Is it possible to perhaps increase your class, Professor, to be more than 2 days?
I'd be delighted to. If there are, I mean, I think Mac and I both concur that it is a very compressed time period and we have to cover a lot of things. One of the things I didn't have occasion to say, Anna, and maybe Mac already addressed this, is part of the class has to do with problem sets to make it both timely, current, as well as practical. So we do set aside a little bit of time, excuse me, for that, and we definitely would have the ability to cover more topics if we were allowed to go to a third day, and I certainly welcome that, but Mac and Jonas will have to decide about that point. And the other thing, Mac, is I hope you'll let me through the Vienna airport if I have to fly in there.
I hope so too. We'll keep fingers crossed. And additionally, if the outcome will be that we stay in Vienna, of course, Jonas and me will directly also contact you regarding the setup of your module, and maybe even also if there is enough to cover, maybe even stretching it. So this is something that Jonas and me will definitely also approach to you at this point.
Just parenthetically, you know, we had to, well, yeah, I think that we can easily do with additional time if you give us the scope to do that. So
Yeah.
All right. Well, I would say that wraps it up. We have some final comments coming in the chat. Thanking you both for your time today, and a lot of people looking forward to the class.
Thank you very much to both of you for organizing this. It was an honor, and I really look forward to meeting everybody in September.
Thank you very much. See you in September.
Look forward to it. Thank you.
Thank you. Thank you very much.
Thank you.
As well, from our side to our IT support, Laura, and Bach out there for making everything run so smooth.
Indeed.
And from the VO Executive Academy, we'd like to wish you all a good evening or a good day, wherever in the world you are. Take care.
Thank you. Bye-bye.
Thank you, Professor.
Thank you, Mac. Thank you, Anna. Thank you, Lawrence.
Thank you, Ron.
Thank you, Professor.
Thank
Bye-bye.
you.
Thank you, everybody.